Hello, coming to you from E-mini Trader Pro, educating day traders. Today is August 16th, around 6:30 p.m. Central Time, and I always want to begin with the cautionary disclaimer that futures trading is very dangerous. And here is a statement from my home page. Performance results have many limitations, and there's no representation anybody will achieve profits or losses similar to anything you're going to find that I'm going to say today. And also recognize the difference between hypothetical results and actual trading, and the ability to lose more money than you have in your account. All of these things make it very dangerous. So now that we've concluded that, if you'll notice on the blog, I discussed the idea that this is the third generation of websites when I've been sharing free education for day traders. And you can see everything from 7-8 years of gathering information on my first two blogs, which are linked right here on the home page. And what we're going to do today is carry on with the theme that I've introduced here, to see how we can get all of the information that a market profile charting package provides and all the understanding of market auction theory without having that complicated software. And in fact, to use the simple candlestick or bar chart and very minimal indications like a couple of moving averages and support and resistance levels that we're going to use on our chart to evaluate the flow of the market from preponderance of sellers or preponderance of buyers as the day may happen to provide. So what I'm doing is introducing actually what you can understand as an analytical method, a structure, a framework. You could look at it in many of these different ways that will enable us to be able to discern at any given time in the market where it's been and the direction that it appears to be headed. Of course, it's never 100%, and we understand that. And analyzing is not the same as actually executing a trade, knowing when to get in and out. But I believe this understanding is basic, and until a person understands a market in the way I'm going to share with you right now, I think they're kind of like up a creek without a paddle, or at a disadvantage, let's say, from somebody who does understand some of these basic principles. And what we look at to start with is support and resistance. I've drawn lines here. Actually, this was during the day of trading on Friday. You can draw these lines, some of them before the open, like the daily pivot, and the night session from say around 6 p.m. Central Time, 6 p.m. The settling from the day before. At some point, the market opens up a little, down a little, sometimes up a lot or down a lot. I mark that with a blue dotted line. The pivot, I make a heavier brown dash line. And yesterday's low and high are also very important. So this is what we have coming in, and I'm considering the start of the day around 8:30 Central Time. That's in Chicago. They ring a bell, and you'll always see some volume spike of some degree. Right at that 8:30, in that first minute of trading, I put a little box here that shows this is where the market went in that first 1 minute, and this is the range during that 60-second period. And you'll find day after day the market jockeys around this initial trading volume, and it's very important in settling, for the buyers, sellers, the participants that day. They get their impression of where they want to put their money, whether it's for the upward bias or the downward bias. Now I'm basically now going to show you the other levels. I look at various pivots throughout the day that are holding for some period of time that'll be important support and resistance. So these lines here, this line drawn from the pre-session a little after 7:30, and then it probed down there, came a few ticks from there, around the 8:30 open. And those are important points. And then finally here they had a very significant event. We'll talk a little bit about that. So the other thing I want to mark is I'm going to give special importance to what I have found is a very significant variable in being able to identify when we've had a significant high or low. When I say significant, I'm talking about a 1-minute chart. Some people might consider that very insignificant. But we're looking at this from the perspective of day traders, scalpers, short-term traders intraday. And when you have a market that's been moving in a direction, such as this, let's say, higher highs, higher lows, higher high, higher low, higher high, higher low, higher high, higher low. Now this low here, I mark it with this magenta color because once we've had a pivot high and then we break it to the downside, this will be an important level that can let us know where the market's at. So when we identify a pivot that has been broken, then we look at that breaking point as being very significant, that often, most of the time, the market participants will probe that level to see if it's going to be sustained as holding, and then the market will break in the other direction, and then they'll see how they can do going in the other direction. And at some point we have these lower highs here, lower low, lower low, lower high, lower low, lower high. And so this last pivot back, I call it, formed here at the low a little after 10:15. Now, so what I'm doing here is and this is all done during the market with significant amount of knowledge in advance when we have the pivot, the session open, the previous day's high and low. The market will want to investigate. The participants in the market will want to see if they're going to have a chance to get on some big move, for example. So coming into this day of trading, this level here, marked by the green line, is yesterday's low. You look at the previous day's high and low as being very significant information, because generally the market participants will revisit that level, at least one of those two levels, the previous day high or the previous day low, and they will see if they can hop on a breakout, and that's generally going to be a significant event anytime there's a breakout. Now, at least significant enough for a scalper to gain the opportunity of participating in it if it does break out. But if it doesn't go very far, you still have a really good scalping opportunity. So these levels, the previous day high and low, are very significant. Now let's look at that, what it looks like on a daily chart. So I've got the daily chart that we were looking at in Friday's trading, and what you had was a low here from Thursday's trading on this bar that basically formed. It ran up in the morning, so it was significant in the sense they were trying to break out in the upward direction after this very strong indication that sellers were not at all committed to the downside, and the market closed almost on the high of the day. So as a long stem bar here, I would call this like a hammer. So a low was pounded in on this Thursday action, and then the day of trading, the day before, they really gave it a good shot, and then eventually they sold off into the close. So coming into Friday, we want to see if they're going to sell again, if they're going to try to go down to these lows, say, something like that, or maybe they would go halfway. So you'd have a good opportunity when you have a reversal bar like this. You expect that there would be a chance to sell under it and make some good money. Now, when we get back to our 1-minute chart of that, this is where they were first running it down there. Actually, they were doing it in the night session, the early morning trading on Friday. And this was the low point. And when it opened up, it was above that green line of the previous day's low. And the participants knew they'd been trading down there in the night session and early morning trading. So the first thing they do right off the open, about third minute into the day, is they slam it down, and they just bounce right off. They didn't even make it. They only made a few ticks from that previous low that was made in the morning, and they ran up. So then this level of yesterday's low held on some pretty strong testing here, and the market made higher highs. So all this went on up until a little after 9 in the morning, so a half hour after the Central Time trading session opened. And then this low was formed on the last pivot back of that move to the high, and then that became an important level that you could have sold this double top here. These two bars, one at 9:11 and the next one at 9:18, formed the same high to the exact tick. And then the selling proceeded right down to test the yesterday low level. They bounced again, probed a little farther, resisted on the night session open, so then that meant they were going to give it a shot this time and really give it everything they had. So they broke the previous low again here with enough staying power to make a low and then make a lower low. But at this point, when they took out the morning session low, that was when it was revealed that the sellers were not committed. It seems to be repeated support at these lower levels. Now, what I'm doing right now is I'm sharing with you what I've learned over the years. The way the market establishes one of these lows is generally with patterns indicating that there's been a repetition, there's been some strong verification of the probing and the testing, and that means multiple repetitions. So what we had, the final low was put in here. It was tested 4 or 5 minutes later, tested another at 10:37. The low occurred at 10:10. 27 minutes later, it made another low a tick or two higher, which you could interpret as a head and shoulders. Doesn't have to be precise. But a low was before the low and a higher low after the low. So we have a head and shoulders here. We have really 4 lows that formed right at this significant area of the 8:30 session low and the early morning trading low, which was broken briefly. And this is what I call a stop run hook. This is another hammer which they immediately reversed strongly. Buyers came in quickly. So this is what we're doing. We're using candlesticks to gain this kind of market profile information by looking at price action patterns and by looking at bar formation. The candlesticks give us valuable information when there's a rush of the market participants going in the opposite direction from some test of a significant higher low. So now this magenta line again is on the last pivot back before this low. As soon as we can identify a lower low, a lower high, we put our line there, and then we sit back and say, are we going to break this last pivot back? Is market structure going to turn into an upside bias? Well, they broke strongly, so now this becomes a key level that we can use as a marker of a much higher level of conviction that we really know what the market's doing from this moment on, because we've looked at the price action at the important market structure points, and we've observed a breakout of the last pivot back, and now the market's into some rotational behavior here, And if it rotates and holds at this level of the last pivot back, it means the market's establishing an upward bias. It's establishing conviction to trade at higher levels, and it's done probing the downside for the day. It's going to rotate and see if it can find interest in the upside. So now I'm going to go to the second video on this topic, so be sure and look for part 2, as we'll break the video here and proceed for completion of our understanding of this process.